So, thank you so much for doing this. DBS, probably more than any other bank, has a reputation for being thoughtful and prescient under your management. And, most people associate fintech with ESG. And, if you talk to the people at Ant Financial, they say, oh, we believe in financial inclusion and it's all about technology, and only fintechs can really do ESG. Tell us about the initiatives under your leadership at DBS and the extent to which COVID has changed those priorities, if at all.
So, Henny, I'd say, first of all, when you think about ESG, it's a broad frame, but the environmental component of the frame, a large part of it, the impact that banks and banking make is through what they finance and what they don't finance. So it is really nothing even to do with the inclusion component or technology. It is to do with the fact that our decisions on where money goes can shape and drive the future of economies and the future of the world. That's really the single biggest impact that banks make in that whole ESG spectrum. Now, that you don't have to be fintech. You just have to have a way of thinking and a philosophy and a policy approach around how you're going to make impact through your financing choices. And by the way, let me start with that. This is very complex. It's not easy. The easy short answer is, let's take the carbon complex. It's very easy to say that we will stop financing things to do with the carbon complex. But the truth is that that kind of binary answer is just not possible. The only way you can do that is if you're willing to take the world back to 10,000 BC, because everything is part of the carbon complex. It's not just thermal, it's not just the energy complex, it's real estate, it's shipping, it's aviation, it's agriculture. So you can't stop financing everything. So then clearly you're going to start having this big debate on what are the positive externalities and what are the negative externalities. So if I'm going to finance agriculture and it's going to create food for people, or if I'm going to finance property and it's going to create housing for people, those are really important in the livelihoods of people and in the shape of society. I've got to weigh that and balance against the carbon footprint that these activities create. That is not easy to do. The measurements are imperfect. The accounting for externalities is imperfect. Impact-weighted accounting doesn't exist. And yet, we as banks sit right there trying to make these judgments on what is the right thing to do. Now, fortunately, everybody recognizes that a binary solution is not possible. So people recognize the need for transitions, that we want to get the world to the right place. So how do you start transitioning from where we are, which is, call it a brown world, to eventually a light green world and then to a green world? So I think transitions are important, but even transitions are not straightforward. We at DBS earlier this year, I think we're one of the first banks in the world to publish a whole taxonomy around transition financing and a policy statement saying how will we do transition financing in 8 different sectors to move from brown to light green to green. But again, there is no definitive and global view on how you get from point A to point B. You've got to come up with your own perspective on how you're going to get this transition financing right. In some cases, you can be more aggressive. So we announced a couple of years ago that we will stop financing coal, both thermal energy as well as mining. I think we have one project which is probably going to get over by this year. But as we get to other parts of the economic system, we are a lot more measured about the glide path, but where we are and how does it take to get to where we want to be. There is another part.
You're also, let me just interrupt 1 minute. In addition to being the premier bank in Singapore, you're a regional bank. To what extent should different countries have different standards? India has said, we're a poor country. We shouldn't have as rigid standards as richer countries. To what extent do you think that we need to have one common standard, or that different countries, depending on their economic development stage, should have different standards?
So Henry, this obviously debate has been going on globally. The UNHCCC has been, the whole debate on that has been architected around this since the 1990s, and which is why they came up with NDCs, the nationally determined contributions, which said there is no one standard, that every country has got to commit to a set and a glide path which makes sense for the country's own circumstance. I don't want to, there's obviously a lot of arguments for, whether you should take a consumption view, in which case the carbon consuming countries should be have a higher bar than carbon producing countries and so on. But forget all the arcane details of that. The reality is that some countries, you take in Southeast Asia, Indonesia, Vietnam, Myanmar, India, even the International Energy Agency has posited that these countries will need to continue to increase thermal consumption for almost the next decade, up to 2030, before they start reducing the thermal consumption. Right now, that's an IEA projection, and therefore these countries, in many ways, seem appropriate when they say, look, given our circumstance, given that millions and hundreds of millions of people in our country don't have electricity today, it is appropriate for us to continue to make that the priority, social development, and then we will start calibrating to the environmental issues later. The problem with this is only that once you give people an out, people try to drive a truck through it. And therefore, I think the role of banks like us is to try and make sure that countries and companies and our clients are kept honest. We have to recognize that transition processes will be different, but we do have a role to play in trying to accelerate and keep people honest to a long-term agenda. I think that's an appropriate role to bestow on financial sector companies. And I think, by and large, increasingly, many banks are beginning to take on that role. So it cannot be turn off the tap tomorrow, but it cannot be we leave the tap open and we'll worry about it 15 years later. The world can't afford that. There's another dimension to this which is easier. Henny, we've been doing a lot of that too. And that is, what do you do more of? And under the prism, it's quite clear that if you open the taps and do a lot more of the right kinds of projects, so renewable financing, for example, sustainability linked loans, for example, green bonds, for example, by facilitating and making cost of financing and funding easier for those kinds of projects, you can actually incentivize the transition yourself. So that's the other thing we've been doing. We made a commitment to do $20 billion of sustainable financing by 2024, I think. We're well on the way. We've done almost 40 renewable projects in the last 3 years. We're doing solar, we're doing wind, we're doing geothermal, we're doing waste to energy, etc., etc. Now, by doing some of the stuff, you start lubricating the wheels of that shift, and that's not a bad thing to do. Last week, we announced a green bond for Star Energy in Indonesia, a geothermal project. Now, it's not a brownfield project, it's not a greenfield project. It's a project we financed on the bank books 3-4 years ago, but the project was now ready to take to the bond markets. It is $1 billion issuance. It was really well oversubscribed. But the really interesting thing is we drove pricing 45 basis points through the conventional pricing. So you got what I call today a greenium. There's enough money, investor money, which is willing to accept lower returns for green assets. Now, if you can start doing things like that, then you make it more competitive for countries to start switching their own mix. And I think that's the other thing we can do. So what do you do less of, but be sensible about it and make a transition path? But what do you do more of at the same time to facilitate easy money going into the things that you want to go to? So to me, that's the big part of where banks really make a difference. Now, long answer, I know you would like to interrupt me as well, but...
No, go on.
The second part of the ESG, though, is the issue around financial inclusion. I think of that more as the S part of ESG. How do you really bring people into the formal economy? I think it's well proven. The data is quite clear that as people start getting a way to transfer money, they get into the formal system, they get access to credit. That's a fantastic way to improve the overall lives of people. And I think that's very important. Now, there is no necessity to believe that only fintechs can do that. I think, my general belief in digital, as you know, that technology today is available to everybody. Amazon and Alibaba, frankly, They give the technology to you for use as part of their web services. So the question is only how do you create a system to be able to leverage the technology so you can do what the big techs do. You got to, the key issue is you got to lower your cost of customer acquisition and you got to lower your cost of transacting. That's what makes it economically viable to reach out to the bottom of the pyramid. In the past, the bank's systems used to be brick and mortar, branches, feet on street. These are very expensive mechanisms, and that's why it's been very hard for banks to get down to the bottom of the pyramid. But once you start applying technology to do that, things change. So the best example of that is actually not DBS. It's what State Bank of India under the last regime, Chairman Rajneesh, they opened 300 million accounts under the Prime Minister's Jan Dhan Yojana. And those accounts today have almost $10 billion in balances. Now, it didn't take a fintech to do that. The State Bank of India, which is a traditional state-owned bank, can do that because technology lets you think about that very differently. We are doing much the same thing in our own way. So in Singapore, for example, there's very little unbanked, you would imagine, but there is one segment, that's the migrant labor segment. There's 700,000 migrants in the country, and by and large, they don't get access to banking financial services. So we took on this challenge to say, how do we bring them all into the banking system? We worked with the government to simplify the account opening process just by doing automated file transfers. We converted the way we opened accounts for these people from a physical account to a virtual account. And we basically gave them all very simplified digital banking tools so they can do their activity like transfer money to their home in Indonesia seamlessly and easily. In the middle of the pandemic, Henny, we opened 40,000 accounts for migrant laborers over one weekend. And you can do that if your technology is simple and your technology empowers you, enables you to do this in scale and at low cost. So I think it can be done. The other great example of that, of course, as you know, is even before Alibaba or Ant, any of these people, is M-Pesa in East Africa.
Kenya. Yeah.
Kenya, and then went on to Tanzania, Ethiopia, several countries. And while it was started with the fintechs, today, most of the banks in East Africa have also jumped on the bandwagon. The fact that you can actually take a mobile phone and distribute on the back of that at scale, it's not necessarily limited to some sets of players. Anybody who has a mind to do it and has re-architected the technology can do it today.
Piyush, you know, the fintech companies say that our credit scoring is better. And, you know, if you talk to an Ant or a WeChat Pay, you know, because of their, you know, ecosystems, they say that it's more relevant. And I hear the same argument when I talk to the fintechs in Bangalore. You know, do you have any sense about whether their credit metrics are more robust? And, you know, no one saw the magnitude of the COVID-induced recession. Do you think that fintechs have the robust metrics? Or are we going to see a lot of these firms discover that their algorithms haven't been the geniuses that we thought they were?
So, Henry, I'd say the jury is out, but let me open this thing first. So by and large, I think it's quite clear, the logic is quite intuitive, that the biggest, what risk ranks best in most cases is an understanding of your cash flows. Because it just stands to reason. If you don't have money, you can't repay. So you got to have an understanding of what is your income source, where do you get money from, and that's the best way to predict, will you have the money to repay the loan? And therefore, anything that lets you proxy that cash flow, proxy the flow of money, is not a bad measure for risk taking. Now, if you go back to how banks traditionally underwrite, they use two variables. One, they look at your financial statements, including your income statement, to see how the money comes into your accounts. And second, they go to the credit bureau to see what is your willingness in your past track record. At this point in time, all my research shows that these two variables, your actual cash flow and your credit bureau record, are still the best determinants of risk. I'd say 80% of your capacity to determine risk comes from these two. Now, what happens though is you can, instead of looking at the statement, you can mimic that statement. And if you therefore can find out from other ways, what is the cash flow of this person, then you can actually get a proxy for that cash flow in interesting ways. similar. So to me, what companies like Andu or many of the P2Ps and the fintechs who use alternative data, but finally they get a feel for the underlying cash flow, those models are not bad. They help you mimic the cash flow problem. But then there's a separate set of models which really don't focus on cash flow. They focus on completely different and new kinds of variables. So for example, they'll focus on social media saying, who are your friends? And if your friends are all good people, then the chances are you're a good person. Those models to me are less well tested and less desirable. Now it's an interesting model. It could work, but those have to go through cycles to make sure that these will risk rank as well as a focus on cash flows risk ranks. And that's not entirely clear. If you look at the history in the last 2 years, the number of P2P companies, both in China and the US, who've run into serious problems in respect of delinquencies has been extraordinarily large. And it has been because a lot of them had the maverick models which did not actually risk rank. So when I say the answer jury's out, I think there's some models which risk rank well. There's some models which I think are somewhat specious, unlikely that they will risk rank over the long period of time. Now, what we are doing at DBS, for example, we actually build models much like the people. Where I can get my hands on a credit bureau score and on an income, that to me is still the gold standard. If I can't do that, then I look for what other data sources can I find to proxy that. And where I can get good proxies, I'm quite comfortable with those models.
You know, Piyush, people always say that technology is so benign, it means financial inclusion. But I sometimes worry that algorithms, it's much harder to argue with an algorithm. And some of the metrics that I talk about with the founders of, fintech companies in Bangalore make no sense to me. Do you worry that technology can have a more negative side?
No,
and
without a doubt.
In the opposite of financial inclusion?
Without a doubt. So first of all, it has. So let me start with back to philosophical debate. So I believe the nature of financial services and banking is at its heart to drive financial exclusion. Why do I say that? Because as bankers, our job is to determine and discriminate risk. And therefore, if I think you're not risk worthy, my job is not to make sure I don't give you the loan. That's what we're trained to do, right? So it's not that we give loans to everybody. We choose the people we want to give loans to, predicated on whether we think you're going to pay us back or not. Now, once you apply a human brain, we say, okay, it's okay, he's applying judgment. The minute I convert it to an algorithm, and the algorithm again starts then coming to conclusions that I should not give loans to people X, Y, Z, then it starts getting into the realms of debate. Is this exclusion or not exclusion? Oh, and by the way, if the algorithm, through some strange reason, turns out to focus and say people of this gender or this ethnicity or who live in this neighborhood, all through my algorithmic models don't qualify for credit, oh my God, that is definitely exclusionary. So what you said is correct, that, first of all, the natural bias in financial services to try and discriminate could get exaggerated because now a model does it. So it's certainly not impossible. The other problem you have, which potential this thing is not our industry, you take insurance. So to me, the heart of the insurance industry is based on the fact that nobody knows where the risk is, right? So that's what we socialize risk. We don't know if you have the fatal disease or I have the fatal disease. So we all pay a little bit of premium into a kitty. And so the one person who dies, they benefit from it. And we are happy to share it because the risk is socialized. But what happens tomorrow when, because of artificial intelligence, we know who has the risk? If it is definite that because of AI and because of my gene pool and DNA sequencing, it is quite clear that I am likely to be prone to cancer, but you're not. Guess what? End of insurance industry, because nobody wants to insure me because I'm definitely going to be on my deathbed. And you don't want insurance because you know you're not going to die. So what happens when your information is too much? When information is too much, then you actually have to go back and rethink and recreate the fundamental business models and building blocks in many cases. So I do think there are potential downsides and dark areas to technology, particularly data, which we haven't really come to grips with yet.
I spend a lot of time, whether it's in fintech or medtech, thinking what is real science and what is pseudo science. And it's a very important distinction to make, right?
Well, that's true. But, I think what is going to force us to do, Henny, is see, we're going to have to grapple with the fundamental issue of what makes us human beings and what makes us social creatures. So going back to my idea of insurance, if we collectively believe that it is in the best interest of all of us as a people, a being in society, that we should socialize and share risk, right? Then at some stage, we're going to have to come to the conclusion that it's better not to know. Now, we haven't come to grapple with that. Today, the basic understanding is that knowing more, having more information, having more data, applying general intelligence is always better. But it might not be the case. So you got to go back and re-examine the rubric, right? So I don't know whether you call it real science or pseudoscience, but to me, there are elements of the social sciences behind it, right? So we haven't grappled with that adequately.
Do you think that, that private capital and public capital should be working together?
Yes, very much, very much. So I think particularly when you start thinking about going back to the sustainability agenda, when you think about the long-term consequences of biodiversity or climate change, these are really important long-term issues, but they require both private and public capital to come together. They require both private sector and public sector to come together, because they cannot be addressed by oftentimes. Some projects you can, but oftentimes you can't. So I think it is important to really start thinking along those lines, without a doubt.
So let me ask you finally, Piyush. I mean, it's been very depressing to me to look at how inadequate the response of many governments has been to COVID. The playbook is fairly clear. There should be a sense of urgency. And yet so many governments have been found wanting. And, there's no sort of predictability. It's not any divergence along lines of economic development or anything like that. So how optimistic or pessimistic are you about the government's ability to respond to the much longer term threats of climate change, rising sea levels? Does the private sector have to step up and do more in a world where many politicians only think in terms of 2 or 4 year election cycles, and bureaucrats have no incentive at all in many cases?
Well, I think everybody needs to step up, Penny. I think the private sector needs to step up more. And frankly, on the back of COP21 and now the pandemic and business leaders roundtable, I think the issue is getting more and more top of mind for the private sector. But the reality is the private sector cannot operate alone, because in many ways, the private sector's actions have to be determined by a policy framework, but more importantly, they've got to be informed by government actions. So again, let me give you a case in point to make that example real. If you think about the possibility of rising sea levels, Singapore is an island country, and a large part of our coastal lines are going to be severely impacted if the sea levels rise 1 meter. That could happen. If I had to project over the next 50 or 100 years, and I did my stress testing and said, okay, sea levels rise 1 meter or 2 meters, what do? I would turn around and say, I'd better stop doing financing of any residential or any property development in almost half of Singapore, anything to do in the coastal region.
Yes.
Now, that would have really important consequence, because the government is trying to make sure that people have places to stay, they have homes to stay, they're building districts. And here the biggest bank would say, hey, cannot do that because I don't know what's going to happen to sea levels. However, I have to take into account the government thinking and framework. The government has also said that we are going to try and spend $100 billion over the next 50 years. We're going to try and put boulders, put dams. We're going to have the following mechanisms to try and protect against rising sea levels. So as a private sector entity, I cannot frame my response and my actions divorce from what the public sector is planning to do and what the policies and actions are in that regard, because otherwise I would make the wrong decisions. So my point is, this has to go hand in glove. It's got to go hand in hand. And so to that extent, I worry a lot about what you said. The governments which are forward thinking, forward looking, and are able to come up with a policy prescription, make it easy for the private sector to operate within that. And so you get a win-win. But the governments which are not, make it really hard for the private sector, because then we have to think in our little well, and we've got to think in our little world. And the chances are you'll wind up making suboptimal decisions if you do that.
Thank you so much. Piyush, you've gotten us off to such a great start for our discussion. You know, and I hope that other panelists will pick up your point that to think about ESG is a kind of risk management. And the risk of not thinking about it is much greater than the risk of thinking about it.
Well, you said it better than I could, Henny. That's exactly right. I agree with that.
Thank you so much for your time.
Pleasure doing this.
Love seeing you. Thank you.
Okay, bye now.
Here. You'll have to see me when you come to Hong Kong, of course.
We'll do that, of course.
Thank you.
Okay, I'll wait for you to give me a call sometime. Take care.